When a business owner gives me a call and asks me, can I qualify for a loan? When I go through the consultation, I start really digging deep into their profile. There's three major pillars that I look for. And this is what I'm going to teach you in today's lesson, the three financial pillars and the guidelines associated with it. So the first thing we look for is personal credit. Now, we like to shoot for around a 700 FICO. There is certain exceptions to the rule. If you have a 660, usually the bare minimum, but 660 to 680 is where it's a little bit of a subjective element. Now, there have to be other compensating factors of why is a credit score low if we were going to accept somebody at a 660 FICO. The next element is credit utilization. The ideal target is maximum over 30%. However, there's certain exceptions to the rule. If you have a 40 or 50% utilization, but you have high financials or a great credit, business credit, there's a balance. They always look at the total overall picture to determine if one element is stronger than other in order for them to move forward. Now, one of the biggest challenges that I come across with business owners is credit strength. Now, people come to me with one trade line with a $5,000 limit or a $1,000 limit or 500 credit score credit limit, and they ask me for a $100,000 loan. Well, the logic behind it is if you're going to ask a bank to give you $100,000, however, and you have a total account of $3,000 or $500 credit card limits, do you think that bank is going to trust you with $100,000 when you haven't demonstrated to be able to repay that amount? So it's always important for you to build on your credit, and I like to have at least a $30,000 to $40,000 minimum threshold in total accounts. What does that mean? Mortgage, auto, installment, revolving accounts. Those are the compilations or the types that I like to see. Minimum of 4 trade lines, seasoned for at least 2 years. That it gives you that establishment, that history, and enough accounts to show a lender that you can pay back the debt in a timely manner and on time. All right, so this credit score is not only a determining factor. You could have 2 credit cards and have a 750 FICO, but it doesn't show that you were able to repay that debt, whatever you asked for to borrow back. No derogatories. Now, of course, there's exceptions to the rule. Of course, if your business credit or your financials are very strong, or how recent the derogatory is, if it was something that was 5-6 years ago, it's in the past, there's a blemish here and there, but if it was a series of different derogatories, late collections, charge-offs, that can give you, it'd be much harder for you to qualify for the loan. So of course, there are exceptions to the rule. I've been able to get exceptions through my bankers, by having a good story for what happened. My bookkeeper, I was on vacation, there's a blemish here, but of course that consistency can tell a story about your habits of paying your bills on time. So again, if there's a good story for what happened and there's other compensating factors, you can bypass that particular rule. Inquiries. So the rule of thumb is no more than 6 per 6 months. In order to get you qualified for a loan, the banks do not like for you to be shopping. If you had 15 inquiries because you went to apply with all these different lenders, it could scare somebody. Why are you looking for money, right? So spread them out in a timely manner and don't go crazy in a very short period of time. So make sure that those inquiries are low. Now, I wanted to dive a little bit deeper into business credit because not a lot of consumers or business owners really understand the mechanics of business credit and how important it is to start building and start working on this, because just how a creditor or a lender will look at your personal credit and the different strengths and all the factors is very similar to business credit. So showing that establishment. So one of the first things I wanted to talk about, it plays a very great and essential role if you're going for a business loan. Okay, so the history of these accounts, right? The existence of business debt is very similar to the personal aspect, where you the credit strength, the history, the limits, derogatories, inquiries. These are something that's very, very, very similar and mirrored on the business side. Now, just how we have Experian, Equifax, and TransUnion for personal credit, there is a few more on the business. So one of the most common ones that we always hear about is Duns and Bradstreet, D&B. Okay, and so fun fact for you guys is actually one of the oldest credit bureaus that exists in the industry. I think it was something around like the 1900s or late 1800s or early 1900s is when they were established. There's over 265 million business records. By far the biggest out of all the credit bureaus that exist right now. So there's a few different scoring factors that they have developed. One is called a delinquency predictor score, where it ranges from 101 to 670, short for DPS. There's a financial stress score, FSS, which is about 1001 to 1875. But the most common that we always hear is a paydex score. And that ranges from 1 to 100, the higher being the better strength for you. Now, we always want to say, oh, do you have an 80 paydex score? And in order to get that, you need to have at least 4 trade lines being established on your business profile in order to get that 80 paydex score. Very important to add. And I'll dive a little bit deeper into how this all works together, when we get to the end of this, including Duns and Bradstreet. One of the other ones. So you have a FICO score for for personal, and there's also one for business. So that's called the SBSS score. Very common. SBA is one of the leaders that utilizes the SBSS score, so especially in the 7A. So if you're going for an SBA loan, you're going to go for that 7A or the 504. That will most likely be a determining factor. I think nav.com. There was one more other one that you can purchase. I think called Bowfly or some sort, that you can purchase your SBSS score to determine what that is. Now, the funny thing about FICO, because it's in order for your personal and your business, that the data can be taken from your personal credit, and it comes up with a blended element that will actually give you a business score by merging your personal credit. It's a little unfair, but they merge the two, provide a score, and the ranges come from 0 to 300. The higher is better from there. Okay, so understand that SBSS is very commonly used in a lot of different business banks. Now, PayNet. Not a lot of people don't understand about PayNet, but PayNet is really used for equipment. So if you're going for equipment financing, PayNet is one of the dominant credit bureaus utilized. Sometimes you'll see PayNet and Duns and Bradstreet, or PayNet and Experian. There's compilation. Sometimes lenders will use all of them. So that's the key element for the major banks, especially. They use a compilation of different credit bureaus to determine your lendability, your bankable legibility there. As we know, Experian, now they also take a blended data of the owners. So if you're an owner and let's just say you have 4 different partners, they'll take a compilation of up to 4 different owners and put that data together and create what they call a IntelliScore Plus SMs, which is an 800 data points that they gather, 1 to 100. Of course, the higher the better. And the personal credit can impact the business credit for Experian as well. They gather information from public records. So if you have a bankruptcy, or you have your when is your business established, what your company does, all that information gets compiled together, and your IntelliScore gets generated at that point. Now, one thing is they have a new partnership. I believe they're coming within maybe a year to 2 years, so they could actually be utilizing it right now. But SBFE, which is actually called the Small Business Financial Exchange, is a lot of data gets pulled from there. So the SBFE and what's being reported on here can aggregate and go to Experian. All right. So again, 1 to 100, the higher the better. If you ever get a chance to pull an Experian credit report, you can go through. You will understand a lot of these talking points. Very similar to Experian is one of the big 3 for personal, Equifax business. The information is also being derived from public records, very similar to Experian, and also it pulls the data from SBFE, which then it aggregates and pulls it all together for that data points. All right, they have something called a delinquency and failure scores, which predicts if the company is going to go into bankruptcy within 12 months. So you can see the algorithm that they have compiled here with your business, the trade references, delinquencies, all that data gets compiled up, score gets generated, and they can tell a bank if you're going to go into bankruptcy. Pretty scary, honestly. So payment index 1 through 100, the higher being the better here. Now, of course, a small business financial exchange is a non-profit organization. It has about 32 million businesses derived from it. Now, 22 out of the 30 top commercial lenders utilize and report to SBFE. Now, you can't just go out there and get an SBFE credit report, but I wanted to make you guys let you guys make it aware, because it's an important it's not even as actually a credit bureau from what I understand, because it integrates and talks with Duns and Bradstreet, Experian, LexisNexis, Equifax, and it's kind of like a partnership. If I think the best way I can describe it here, but a lot of these different accounts come together. There's 78 million of them now. Just the big fish from American Express, from Capital One, from PNC, even Lending Club, SunTrust. A lot of these lenders utilize and will pull an SBFE report. Okay, so understand that if you have a delinquency, let's just say in Duns and Bradstreet, it could actually affect SBFE. And the SBFE also integrates with Equifax and Experian and LexisNexis, and so you see how everything is somewhat intertangled between each other. Okay, now a lot of lenders will look at pulling a Duns and Bradstreet and an SBFE, or a Duns and Bradstreet and an SPSS, or vice versa. And a lot of them won't talk with each other. So you could have a trade reference on D&B, but it won't be reported to Experian, or it won't be reported to Equifax. So it's important to understand, if you're going to go through lending, which banks pull which credit bureaus. So it's an important element. Now, moving forward here to financials, which is one of the, I would say a lot of, I think they're all very, very important though. But, if you don't have personal credit, but you have the financials, you're able to get a loan. If you don't have the financials and you have personal credit and business credit, there's a lot of different opportunities for you to get qualified for a loan. So making sure that the health of each one of these pillars is what going to determine how much money you're able to qualify for. But getting deep right now into the mechanics of financials, of what the banks look for. So very, very common actually. A lot of clients, let's just say, I ask them, so how much money are you looking for? They're like, I want $1 million. Okay. The calculations for banks, and what they use, at least for the major ones, is anywhere from 10 to 20% of your gross sales. So if you made $1 million, now a bank will give you typically on average about 10% of that, which would be $100,000 in a loan amount. So if you're asking for $1 million and they're giving you 10% of your sales, you're going to be over leveraged if you go and hit that $1 million. So it's really risky for a bank to give you that amount. So that's typically 10 to 20% is the gross calculation on average. Now, if we're going full documentation, they look for 2 years of financials. Now, a major bank wants you to be in business for 2 years because it's going to show a history of your growth. All right. So your business tax returns for, let's just put tax. Quick and easy. So 2 years business tax returns, we look at the gross, we look at the net, we look at personal, the gross, and the net. Now sometimes banks will look at what we call the global coverage, or the global exposure of how well a business is growing. So a lot of times with the challenge that I always face is you make $1 million, but you want to write off everything. 99% of it is expenses. Of course, the bank's not going to want to lend money to you, because if you're only profiting 1%, the banks are not in the business of losing money. Now, there's certain things we can do by adding back depreciation and interest, but that's the high-level mechanics for what we look for, right? So they calculate the business and the personal. When you go for a mortgage, they always want to look for what? 2 years history. So for business loans or any type of, it's always a 2 years. It's a rule of thumb. Now, interims, right? Interims means that, what are you doing, year to date? So look at your profit and loss and your balance sheet. And so this is where we look at banks like to see growth. So if you started out in your year one and you're at $200,000, year two, you're at, $500,000, and then all of a sudden you hit, 1.1 or 1.5 million, in your year to date, banks like to see that steady growth, because if you go from 100 to 5 to a million, what's the next year going to be, right? 2 million, then 5 million, and 10 million. Then all of a sudden you grow up and you be 100 million. The bank wants to be an essential part of that. So banks want to lend to people who don't need money, but also like to see projected growth. So it's important to understand and to compile that story when we are delivering, presenting to one of our major entities or the major banks when we move forward with that. Now, a personal financial statement is your personal information, your assets and liabilities, with who do you have, personally. A lot of banks like to see personal liquidity, your 401k, stocks and bonds, etc. And that's just information that they typically ask for when you're going full doc. Yeah, business debt schedule. So how much business debt are you in? Okay, did you take out some of these merchant cash advancements, which they're known for going for second and third, fourth, fifth? I've seen even as long as 13 positions behind, the first. So banks, major banks at least don't like to be in second position. And a UCC filing, which we're going to get into another video, is a lien that gets placed on the company's business profile, which can encumber certain assets, or letting the world know that they have a loan, based upon what they're lending you. Assets. It's a very when I look for and I qualify an underwriter file, I ask them, do you have any assets? Because maybe if your business credit is not so strong, or your personal credit is not so strong, or maybe even your financials are not that strong, but if you have assets that if you default, it's collateralized, right? They take the asset away. So it's a lower risk factor for a bank to look at and see and ask if you have any assets. Now, accounts, so what are some of the acceptable types of assets that banks like to see? You have accounts receivables, your inventory, real estate, and there's a few other qualifying aspects for assets. But typically, if you're going to ask for more, 150 or 250 and above, a bank's going to want to see your accounts receivables aging report, right? Who owes you money, and can we attach our lien to those particular assets in case you default? Okay, so cover that. Now, bank statements. What I found for major banks is that they don't typically ask for, bank statements. Some of them do. Very, very heavily used in the alternative lending space. Merchant cash is one of the big ones that they'll look for, 3 to 6 months of bank statements. What do they look for? They're looking for cash flow. Okay, in another video, I'm going to be describing something called a debt service coverage ratio, diving deep into, can you afford that? But merchant cash, they go through how much cash flow are you looking at, usually for 3 to 6 months. Okay, so here's really high level of, business, obtaining a business loan. If you're looking for personal, very, very similar, but without the business. Personal, 1 or 2 years in your personal funding aspect. If you're looking for a personal loan. For business, this is what they look for. This is what at least the major entities look for. Going through and slicing down and seeing if you qualify, or there's any factors that can determine the approval or your denial. Hope this helps.